What's up, everyone? It's Caddy with Money Investing. So, quite an interesting day. The market's pulling back. On the week, though, we're still green, we're still higher, and all eyes are now going to be on the FOMC going into next week because it's all down to what Jerome Powell and his colleagues at the FOMC are going to do with respect to interest rates. Are we getting a hike? Are we getting a pause? Are we anticipating cuts? What is going to happen? There's a lot of discussion and debate around whether we're already starting to see some forms of quantitative easing with the Federal Reserve's balance sheet pushing higher by close to $300 billion. So lots to unpack in this video. Silicon Valley Bank also filing for Chapter 11 bankruptcy. And of course, consumer sentiment also came in a little bit shy of what the expectations were. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us and get access to all the alerts, all the investing ideas, and of course access to all the private videos and tutorials and exclusive lectures and a lot of other spreadsheets and benefits as well. So link's going to be down below. There's limited spots left with a 16% annual discount if you are interested in joining. So first things first, let's talk about the consumer sentiment. Came in a little bit over 63.4, down from 67. So consumer sentiment did weaken a little bit. This was for the month of March already. And it should improve over time. We should start to see it a little bit of improve because oil prices are coming down. So crude oil prices, when gas prices are coming down, consumers are inherently a little bit more optimistic and more upbeat as opposed to anything else. But of course, with the contagion with Silicon Valley Bank, First Republic Bank, the confidence or the trust in the system is really not that strong at the moment. Speaking of, Silicon Valley Financial files for Chapter 11 bankruptcy with about $2.2 billion of liquidity. Now, Chapter 11 is a little bit different than Chapter 7. Chapter 7 is a full bankruptcy where the company is not going to exist after the bankruptcy filing proceedings are done. With Chapter 11, it's more of a reorganization. So you are going into receivership, of course, with FDIC in this case because it's a bank. And with Chapter 11, you're also going to be reorganizing your structure and making sure that you are able to make those obligations on your debt and kind of meet those obligations with your creditors and still exist. And there's at least a part of you that exists after the bankruptcy filing proceedings are completed. Now, Fed poised to approve a quarter-point rate hike next week, despite market turmoil. So there's been a lot of discussions, as I said. We've been going back and forth. The markets very much in the last few weeks here have gone from a 6% terminal rate down to 5% terminal rate, expecting 50 to 100 basis point hikes to as low as 25 basis point hikes and 6 to 7 cuts priced in as it stands right now. If you consider one rate cut as 25 basis points, right now, the market's pricing in for 7 now. 7. It's not 6, it's 7. And that's, if you kind of do the math, that's going to be 1.75% if you consider every single cut to be 25 basis points. A consensus has emerged that the Federal Chairman Jerome Powell and his fellow central banks will want to signal that while they have attuned to the financial sector upheaval, it's important to continue to fight to bring down inflation. That likely will be taking a form of 25 basis point hike, accompanied by assurances that there's no preset path ahead, and the outlook could change depending on market behavior in the coming days, but the indication is for the Fed to hike. And I think 25 basis points is pretty much going to be on the table, a done deal. And what happens next is going to be anybody's guess. I think Jerome Powell is going to be very similar to Christine Lagarde's ECB speech, where they mentioned that they are still on this fight to bringing inflation down. In other words, they're not giving up. Jerome Powell is not going to blink. They're not tapping out. They're still on this path to bringing inflation down while making sure that they are keeping a close eye on the economy, the banking sector, and also being data dependent, right? That's exactly what Christine Lagarde mentioned during the European Central Bank press conference. Data dependency is something that, is the word for 2023, I feel like, and even 2022, because that's really what they're focusing on. But their data, of course, is also very much on the lagging side because they're looking at CPI, PPI, PCE, all these metrics that are more on the previous month, not any of the leading indicators, which could be more the recent prices for commodities and other indicators that can suggest that the economy really is starting to pull back. Now, there are recession cracks. Unemployment's ticked up. Consumer sentiment's coming down. Retail sales turned negative for the month of February. So there are recession indicators to begin with. The money supply is contracting in the first time in so many decades, down about 2% year over year. So again, eventually we'll find out how everything plays through. But in my opinion, I think 25 basis points is pretty priced in from Jerome Powell. What happens next is, like I said, anybody's guess, but I do also expect the economy to start to show some more cracks in 2023 if the rate hikes are higher for longer, as Jerome Powell has already mentioned and talked about in his previous reports, and of course his testimony in front of the U.S. Senate and the U.S. Financial Services Committee. Now, a question of stability, whichever way the Fed goes, it's likely to face criticism, and that is true. I mean, if they actually pause and don't do anything, they're going to face a criticism that they are giving up on their fight to inflation, and they are going to lose somewhat of their credibility. If they raise rates, that's going to be tightening financial conditions even more. So, if you guys remember, I actually did a video 6 or 8 months ago talking about how the Federal Reserve is going to eventually be in a rock and a hard place. Well, this is it. This is exactly it, right? The Federal Reserve and Jerome Powell is literally in between a rock and a hard place, because whatever they do, the outcome is not going to be great. This might be one of those times where there's difference between what they should do and what I think they will do. This is from Mark Zandi, chief economist at Moody's Analytics. And people are really on edge, and any little thing might push them over the edge. So I don't get it. Why can't we just pivot here little and focus on financial stability is his question. This is again Mark Zandi from Moody's. And you're not going to lose your battle against inflation with a pause here, but you could lose a financial system. So I just don't get the logic of tightening policy in the current environment. Now that's all good. Like I do agree with that statement. I mean, you have a much bigger battle with inflation right now, but if you continue to kind of raise rates and stay here for longer, there is a chance that we could start to lose financial system as well. In other words, recession cracks showing up, unemployment spikes, more layoffs, more banking failures, more problems in the economy that we can't really comprehend right now. And that it's possible, right? Those things can actually get worse. However, his first statement, you're not going to lose your battle against inflation with a pause here. That we don't know. We don't know. How do you know? How do you know if we pause here where inflation is going to actually stabilize and come down and keep coming down to 2%? We don't know that, right? What if inflation gets a double top, just like we did in the Great Inflation from 1970s, 1980s, because of prematurely loosening policy? Paul Volcker and the other Fed members at the time, 1970s, they pulled back on interest rates, and then inflation pretty much rocketed back higher because of all the quantitative easing. And then we had a double top in inflation that had to really crush the economy down in order to bring inflation back down to levels consistent with their dual mandate. So that first statement is making an assumption. Obviously, it's not facts, but it is what it is. Everyone's got different perspective on what the Federal Reserve should actually be doing. Cuts still expected by the year's end. In fact, Bank of America said the policy moves last Sunday to backstop depositor cash and support liquidity-strapped banks allows the Fed the flexibility to hike. And Michael Gappin said in a client note from the Bank of America economist, and I quote, "The recent market turbulence stemming from distress in several regional banks certainly calls for more caution, but the robust action by policymakers to trigger systemic risk expectations is likely to limit the fallout." And that said, events remain fluid and other stress events could materialize between now and next Wednesday, leading the Federal Reserve to pause its rate hike cycle. So this right here is the current expectations from the Federal Reserve, in terms of where we're going. So markets now pricing in at least 50 basis points, right? 25 in the next couple of meetings. And then we're pricing in significant rate cuts to getting us all the way down to 3.5%. And if you kind of do the math here, we already have 1, 2, 3, 4, 5. So this right here, 5 consistent 25 basis points cuts. And this is one big cut happening in June, apparently, from the Fed Funds futures of 50 basis points. So there you go. That's about 7 rate cuts. If you consider a rate cut to be a 25 basis point, that's going to be about 7 rate cuts priced in at close to about a 1.75% from the market. Just want to make sure that math is actually checks out. So yes, 4 rate cuts. Yep. So that's 1.75%. It's pretty substantial, right? Pretty aggressive for the markets to be pricing in a huge amount of quantitative easing from the Federal Reserve, even though we don't have any green lights. We have literally no green lights. This is just the market pricing in. That's what concerns me. That's what I've actually mentioned in my previous videos. Is like, this is once again the market making the decision for the Fed. You know how it's like putting words in your mouth? That's what the market's doing. This is the market's way of putting words in Jerome Powell's mouth. In other words, expecting huge cuts. We're talking consistent cuts every single meeting, all of 2023 and 2024. How did the market even get this idea? Like, I just... It's hard to understand. And if there is a rude awakening, if for any chance there is a rude awakening, if there is a question that the Fed funds futures, like Mr. Powell, the Fed funds futures is pricing in for consistent cuts in 2023 and 2024, what do you think about that? And if for any reason he says we're not even thinking about cuts right now, we're not looking to cut rates right now, man, this futures market is going to flip like crazy. Absolutely crazy. So be prepared for that. It could be a rude awakening, at least in my opinion, because this is a lot of quantitative easing, which we have little to no information on, and the Federal Reserve Jerome Powell has given us no green lights about rate cuts. So I'm just gonna be prepared for this futures market to flip a little bit, and the markets to get a bit of a rude awakening going into next week. But again, anything is possible. So in terms of the markets, red day, but a green week. So we'll take it. Google here up, Microsoft up, Adobe pushing higher, AMD, Nvidia continues to push higher. Banking, financial stocks were down. Healthcare, we got industrial, real estate, energy, consumer defensive, consumer cyclical, utilities, basic material, everything just really pulling back. Comm services, technology were the only two sectors pushing higher. Gold has done really well, so gold has started to outperform in the markets, as that is also considered as a bit of a safe haven, and of course investors flocking a little bit more towards gold. So all sectors down on the day. In the last 1 week, we do have comm services, technology, utilities, healthcare pushing higher, and over the last 1 month we've got pretty much all sectors, all 11 sectors in the S&P 500 down. Volatility was higher. Silver, gold prices, lumber, cocoa, orange juice pushing higher, wheat, heating oil also pushing through. We did have the Russell 2000, we had coffee, cotton, we got Euro Stocks 50, natural gas all pulling back. And another one that's actually doing well is Bitcoin and Ethereum. So cryptos, we're seeing a bit of a asset allocation towards cryptos as well. A lot of momentum coming in. Bitcoin's trading past 27,500. It's a pretty big deal. And Ethereum also trading past 1,800 at the moment. So a lot of momentum driving cryptocurrencies also to new heights. Got a long way to go, of course, from all-time highs, but next resistance for Bitcoin is going to be sitting roughly at 28,000. And for Ethereum, we're already starting to break outside of this resistance right here at 1,700. So this right here was our previous level. And the next level to really be paying attention to for Ethereum is going to be pretty much at $2,000. That's the next level. That's a previous resistance where we have gotten rejected for Ethereum as well. Now, talking about volatility, just lots of consolidation for the VIX. I mean, it's been a pretty volatile week to begin with. And when we talk about the T-Vol index, the total volume on the New York Stock Exchange, because of the quadruple witching Friday, we did see it spike over 211% right after market close, because a lot of options contracts expired, and we are getting this big, large number. So third Friday of March, and the next time we're going to see this is going to be in the third Friday of June. And again, volatility very much sideways, down, up, so VIX pretty much closed up 11% on the day, trading past 25.5 levels, and really paying attention to 35 to as much as 40. So that's kind of like a level where I would start to look at the markets from a more net buyer perspective, and we'll be looking at dollar cost averaging and opportunities in the markets from a more long-term perspective as well. So those right there are going to be some levels to pay attention to for volatility. Talking about the yields, so yields have been rolling over. They've also been on this roller coaster ride, especially the 2-year has now dipped below 3.9%. So we're sitting at 3.8.5, and 6 months coming down to 4.69. 3 months come down to 4.44, and the 10-year is now sitting at under 3.5. So it's a little bit over 3.4%. So the yields coming down is because prices are moving higher, and that's also one of the reasons why there's been so much systemic fear or risk around the banking sector, as investors, companies, individuals have moved out of equities, moved out of bank deposits, and it's possible that we have kind of shifted more of that liquidity over to bonds, right? And because bonds are, again, backed by the full faith and credit of the United States government, more safe, risk-free, considered to be risk-free, and since the yields are higher, it makes more sense for them to be buyers of bonds, and that's what we have seen because of yields coming down. So as there's more demand, prices going higher, yields are coming down. That's one of the reasons why I'm still long TMF, and I still want to be long, bond price ETFs, because I do expect upside for this, and it's up a little bit over 4% today as well. So pushing past $9, and my next target really is going to be all the way up to $10 for TMF, and then we'll kind of see if it breaks out of that level. That's going to take a lot of momentum to the downside for the yields, and to really come down for the 10-year to really break below this support right here. So this is going to be that level sitting roughly at around 3.33%. So if we can break down below this level, I do expect more upside and a lot of momentum for TLT, TMF, and for them to continue to push higher even further. Talking about the S&P 500 now. So actually, before we get there, I want to quickly go over the year-to-date chart. So some of the things that I think are very interesting: Bitcoin's up 64% on a year-to-date basis, then followed by Ethereum up 47%. Then we got technology, so XLK specifically up 16%. Then we got QQQs up 15.4%. Then we got communication services. We got the volatility still up 11%. Discretionary stocks up 10%. Gold outperforming the SPY. Yeah, that's true. Gold is actually outperforming the S&P 500 by quite a bit, by 4 times multiple here. Gold is up 8%, SPY is up 2.4. TLT, so bond price ETFs, bonds are actually also outperforming aggregate equities, not saying individual sectors or stocks, but if you take a look at TLT, that's the longer duration bond, 20-year plus, 5.3% gain on the year as opposed to SPY that's up 2.4%. So bonds are actually outperforming S&P 500. Then we got mining's ETF, pretty flat. We got the dollar is flat, just down about 78 basis points. And we got industrials, real estate, materials, staples, utilities. So again, some of the more recession-proof stocks and staple names are down 2.9 and 5% respectively. Silver not doing as much as not doing as better as gold, actually down on a year-to-date basis. And we got biotech down 6%. The 10-year yields obviously down 8%. And we got financials and energy and crude oil selling off. And I've mentioned this at the end of 2022, where I do believe that energy was a great short going into 2023 because of how much it had rallied and the fact that the comparables are going to be far more difficult for these energy companies to comprehend, considering that they had these staggering last couple of years in terms of earnings growth. So this right here is S&P 500. So once again, a little bit of a pullback, down 1%. If you take a look at the week, though, we are still up on the week, up 1.43%. So not a bad week, but definitely a little bit of a concerning day. This right here is going to be the technical. So we do have a very strong support sitting at 37.74. We've already talked about the valuation for the markets on an aggregate basis. So right now sitting at about 17.5 times earnings for the S&P 500. So that's something to keep in mind, because if markets keep pushing higher, the valuation only gets more and more expensive from an aggregate standpoint. So that's something to keep in mind for S&P. But 37.75 is going to be that support right here. We've got a resistance all the way up to 4,100 for the S&P 500. And of course, talking a little bit about the NASDAQ. In terms of the index here, IXIC down 74 basis points, but on the week, though, it is still green. It's actually up a lot, 4.4% this past week here. So seeing a lot of momentum, getting this validation of this previous resistance, previous high, and lots of buyers stepping right back in for the NASDAQ. And the next resistance is going to be 12,280 for the NASDAQ. And of course, support at this level and all the way down to its October lows at roughly around low 10,000s. Talking about Apple, so again, lots of consolidation. We're once again getting a bit of a rejection there at this level. So this right here is something that we talked about. And don't forget, we talked about how there is a potential for a head and shoulders for Apple as well. You can see kind of like a very small left shoulder, head and a right shoulder with a neckline sitting right here. So it is possible that, next week we may see a potential break to the upside for Apple, just depending on what Jerome Powell says, depending on what the policy path looks like. And also we've got the summary of economic projections, and we've got the dot plot coming out, right? That's going to be part of the SEP. Very important stuff, right? And the thing is that dot plot, usually the members of the FOMC have to submit those dot plot expectations, interest rate expectations, a couple of weeks prior to the meeting. But a lot has happened in the last couple of weeks. So hopefully we'll get the most up-to-date. I really, really hope it doesn't come down to a situation where the dot plot is outdated. In other words, they put in those estimates 2 weeks ago, and then we just don't get revised numbers, right? We just don't get the revised estimates. And Jerome Powell says, as you know, that the dot plot submissions are due 2 weeks prior to the meeting. And as a result, a lot has happened in 2 weeks, and we weren't able to revise those numbers. So again, that will just keep things super vague. And once again, the financial markets are moving in such a way that everything starts to become outdated 24 hours later, right? Because everything is developing so quickly. Markets are moving by the second. So I really want them to provide us with the most up-to-date, most recent numbers, so that we can actually have an understanding and good idea on what the Fed's policy path looks like. Anyway, 155 is going to be that resistance for Apple. Amazon, we've got 1% down here on the day, back under $100, but this right here is going to be that lower high. And again, if you take a look at the overall chart and the pattern for Amazon, you'll notice that we are still consistently in this downtrend, so making lower highs and lower lows. So still trading inside this downtrend here. Support level is going to stay put roughly at 80, low 80, $82 per share. That's going to be in line with this previous support that we have validated for Amazon. Talking about Tesla, and Tesla here on the day was also down 2.17%, still validating 175 though, so low for the day was 177. This right here, as we've already talked about, is going to be that support all the way down to as low as 166. So a couple areas of support for Tesla to watch at those levels. And of course, we got a resistance sitting all the way up to 204, 205, to as much as 212, 215. Anything inside this red rectangle is going to be a pretty strong resistance to watch for Tesla at the moment. Talking about NVIDIA. NVIDIA continues to push higher. Hey, this right here is an interesting candle, is it not? This is more of a, well, it's not really a shooting star because the body's pretty long compared to the wick. It's almost identical. So, but this is definitely quite interesting. We got a red candle on a green day. We got sellers really stepping in. If you think about it logically in terms of the price action, we got up to as much as 264. Sellers stepped in to bring us all the way back down to as low as 257, right? So there was definitely a lot of momentum for NVIDIA on the downside. I mean, RSI, there's still a potential negative divergence. I would still call this a negative divergence because this is still a lower high in terms of the relative strength index. So, hey, you never know. We're definitely overextended here. Valuations through the roof, 23 times sales, over 75 times earnings. No doubt, NVIDIA, in my mind, that it doesn't deserve to be trading at 257, but we'll see what happens over the course of next few days. I wouldn't be surprised if we do see a bit of a pullback. But then again, the sentiment is so strong. That's one of the reasons why I don't have a short on NVIDIA, because of the momentum being so freaking strong on NVIDIA. Talking about advanced micro devices, and AMD also pushing higher, 1.28%, a little under $98. We're still kind of tapping onto this higher high. So that's the higher high and higher low pattern for AMD, and we're consistently just trying kind of trading in this uptrend for AMD at the moment. I do have a covered call on advanced micro devices, actually a couple of covered calls, because that's a hedge if and when AMD starts to pull back, considering how overbought it is. Those calls will actually print because they benefit when the stock price goes further out of the money. And for me, that would be coming down and pulling back. Once again, if it's in the 70s and 80s, I'd consider dollar cost averaging a little bit once again. Talking about PayPal, and PayPal here on the day was down 1.83%. So lots of consolidation for PayPal. So we haven't really seen a lot of momentum for this company, and it's still trading inside of this descending triangle right now. So we do have a little bit of a lower high over here for PayPal, and right now we're just kind of drifting lower and not able to break outside of that trend. We did once, but then we got rejected here, $87, $88. So right now, lots of consolidation, support level, and my fair value is going to stay put roughly in the 70s. Support level is going to stay put roughly at $67 for PayPal at the moment. We're just kind of drifting lower and lower. As we kind of fill in this gap, it's possible that we do see a little bit of a bigger move to the upside or to the downside. The problem is that with descending triangles, they are more bearish patterns than anything else. But I have also seen a lot of descending triangles that do break to the upside as well. Talking about Square, down about 1.4%. So we are seeing a lot of consolidation. In other words, still trading inside this downtrending channel, I would say. It's a little bit pivoted here. So that's going to be that potential downtrending pattern for Square. And support level is going to stay put at $59 to as low as $51. Those are some levels that I would be very much interested in taking a potential long trade on Square. Not really be a buyer, but a long trade, a swing trade on Square, potentially at those levels. I did like this, like the Square's numbers, like when they reported earnings, even though they kind of missed on EPS, but their Cash App numbers were phenomenal. Revenue growth and margins, everything was actually really good for Square. Of course, Bitcoins are really low yielding fruit for Square, so that's something that it's not really generating a lot of profitability, but it's there to attract more customers. It's there to generate more transaction volume, and for people to be able to trade cryptos. It's just another user accessibility point of view. I think that's still relevant, but Square really has higher margins on their services and their Cash App revenue as well. So I do like the company. I did like the earnings that they reported, but again, from a valuation standpoint, it's a little too high at these levels still. Talking a little bit about Meta now. So Meta here on the day down over 4.5%. So we're still kind of seeing a lot of ban headlines come in for TikTok, and that's been one of the catalysts that's driving Meta higher. It's been another reason why Zuckerberg has been doing a lot of cost cuts and all these layoffs. has resulted in Meta to be one of the best performing stocks in 2023, especially since November. I think Nvidia and Meta are two stocks that have rallied over 130% since November, done really well. But this right here is going to be that support level right now to watch, sitting roughly at around 198. Actually, we're trading below that level, so that's going to be a resistance to watch at the moment. Support level all the way down to 160s. Once again, that's going to be the gap that we need to kind of watch and see if we can fill that out eventually. So that's going to be that resistance to watch for Meta moving forward. Talking about Netflix, and Netflix here seeing a bit of a downside, 2% downside, and this right here is acting as a little bit of a resistance, which has previously acted as somewhat of a support. So once again, old support level potentially acting as a resistance for Netflix, and the next level really is going to be down to 276. So this right here is going to be that next support level to watch for Netflix, with a resistance staying put roughly in the 370s for the company. Talking about Google, and Google here still pushing higher, 1.3%. So very strong day for Google, breaking outside of that range. And again, we had a trade idea on this, from a few weeks ago, doing really well, pushed up a little bit over 14%. If you want to get access to all these trade ideas and kind of going over certain opportunities in the market, the link to our Discord and Patreon is going to be down below, of course. But we are now getting up to this resistance. That's going to be that lower high to watch for Google. So that's going to be that next resistance, sitting roughly at around $104, $105 per share. Next up, we're going to talk about Microsoft, and Microsoft here on the day was also higher, up 1% and getting up to $279, $280. Next resistance is going to be sitting right here at close to $292 per share. So this right here, next level of resistance. We are getting up to overbought levels, so be careful. I'm not going to be a buyer for Microsoft at these prices. I feel like it's a little too expensive in terms of the valuation, but I will be very much interested in the 218s, 220s for Microsoft. So at these prices, wouldn't mind all cost averaging a little bit at that level. Shopify, pretty flat, no change, up 2 basis points, lots of consolidation. This right here is the higher low or the ascending support, which Shopify seems to be validating at the moment. So right now, all we're seeing is a very, very mild uptrend for this company. So bottom line is, lots to unpack next week because we've got Jerome Powell and the Federal Reserve. So that's going to be a pretty important week. All eyes are going to be on what they do, the SCP and the dot plot. I will try to be live. No promises, but I'll definitely try to be live to cover, most of it. And hope you guys enjoyed this video. Have a great weekend. It's been a very exhausting last couple weeks. So thank you so much for joining in. Really appreciate it. Make sure that you drop a like, subscribe to the channel, and the link to our Discord and Patreon is going to be down below if you're interested in joining us. As always, happy investing. I'll see you all in the next video.